today I wanted to talk about KPIs for stocks and also the narrative of price. So I think we can start with a narrative that's driven by price, which is, in my opinion, an issue that it's so pervasive around everywhere. It's like why this the stock price went down, so they had to find a reason to, a justification of why the stock price of the market or the market went down like 0.5%, and they blame it on like something that's not really the case. But if the stock would have gone up 0.5%, they've found some other title to describe what happened in the market. But at the same time, what supposedly drove down the market still happened, right? So like it just doesn't make sense to me at the end of the day. What I'm talking about is, let's say the market is down 2% because interest rates were up 0.05%. And the next day the interest rates are up 0.05% again, but the stock market goes up. Like, how do you justify these things? I think it's an issue that's so pervasive out there where the narrative is driven by price.
Does narrative drive price? Yes, absolutely. Is there a ton of noise around? Like, my favorite example here is like these enormous companies that have incredibly large enterprise values and established brands and sales that are like fairly consistent on a daily or weekly or whatever basis. Like, are they really worth 5% difference from day to day? Like, is the whole business really worth that much more or less? The market says so, and the market consists of a bunch of noise and a bunch of people moving really fast, and you need to expect that craziness will continue, because the market is an aggregate of expectations, and expectations change constantly with new data or non-data, right? Noise affects things too. So, are these things really changing value that much? I don't think that there's that much signal to be derived from that, which is why you would get like a fake news. It's not fake news story, but like just a made up reason why, a company's stock moved XYZ amount per day. The real boring answer to it is today there were more sellers than buyers, or today there were more buyers than sellers. That encompasses the reason.
That's the reason, yeah. To me, it's always, you have two groups of people. You have the group of people who are like the efficient marketers, the game theorists, I would say like the fundamentalists, the people who actually believe in that fundamentals will drive price and then the narrative, right? But on the other hand, you have like the trend followers, the technicians, all these other people who say narrative drives price, which then sometimes starts to affect fundamentals. And I think it's like a very interesting way of thinking about this. I think that both are right. In essence, I think on the short run, the trend followers are mostly right. It's about supply and demand of specific stocks. So meaning like if, just to give you an example, if today everybody woke up and said, I'm going to buy, I don't know, Microsoft. And so then Microsoft stock goes up because there's way more demand than supply. But over time, I think fundamentals start to matter more, because people are going to see if that stock does well, they're going to want that stock. It's like a feedback loop. I still think it's like pretty crazy that, you have to, like, the newspapers are constantly justifying why the market went up or down 0.5%. And they blame it on some ephemeral like stock market is down because OPEC, released a statement. That doesn't make sense to me.
It's adorable that you just blamed newspapers. Are you receiving newspapers at the housegate?
No, well, I'm just looking on the website, like the first the Wall Street Journal.
We're in the content game now. You have to make up things to talk about. If nothing is happening, you can't publish a video that said, maybe we should do that. Next week, we'll say nothing happened. Nothing has changed. Everything's fine. Everyone relax. And then we'll end the video. But yeah, it's the media game.
Yeah, I guess so. That wouldn't be very searched.
Yeah, that might be an SEO suboptimal video. Hey, market stuff happened. None of it matters. Go back to bed.
And then the second part what I wanted to talk about today is technically like KPIs, key performance indicators, and how important it is that if you invest in single name stocks, which is way more difficult in terms of tracking, I think. I'm sure you would agree with me with that part. That you should be tracking for every one of your big positions. You should be tracking their KPIs in a way that helps you identify business trends for that specific company.
There's a few assumptions in there. One of those is you're hopefully a long-term investor. You're buying a company with the intent of holding it. And the other one is that you're a fundamentals-based investor, not a price-based investor, right? Or anyone who's saying, I'm a business analyst, I'm going to analyze the prospects for this business and therefore this business's stock price. That's the scope of what we're talking about, right? There's people who own stuff for totally different sets of reasons, right? There's market makers and momentum and yada yada.
That's correct. It's for a specific type of investor, but I think it'd be very hard to be an individual person investing not for long term and in stocks. I think that's actually one of the hardest things you could set yourself up for.
I would agree. So we're going to skip that person because they're already smarter than we are. Wink, wink. At doing whatever they're doing. So for the long term fundamental investor who says, I want to own this basket of companies for this set of reasons, what KPIs are you interested in your process?
So it actually really depends on the company itself. So, if it's an e-marketplace, I would be very interested in gross merchandise, or like how much merchandise was sold on the marketplace. That's a key driver probably of many of the other sub-item line items. If the marketplace is selling way more, then it's probably they're taking more fees. So it would be very important to make sure that's something we're tracking. If it's like a credit card company, how many transactions the network had, or like the other part is how much value has been transacted on that network, credit card network. Obviously, gross margins and all the other financial ones are actually really important. So you would talk about like revenue. Did they beat the estimates? Yes.
Do you care about estimates? Do you believe that estimates are like an important data point? So if a company, and could you explain like how that works? Some companies put out guidance. What does that mean?
So companies put out guidance of what they think they're going to do. The market itself kind of verifies that guidance and puts out their own estimates. And the estimates is actually, the way I would think about it, is a first step of understanding market expectations. So it's more of like the experts of that company putting down what they think the revenues will be. And right now, let's say the market is pricing in those estimates. And so if the company beats them, that means that they're beating expectations. And as a result, there's going to be a repricing of the stock. Sometimes they beat the estimates and the stock goes down. It truly is because probably that the estimates didn't align perfectly with the market expectations.
Yes, the book on this subject is Expectations Investing by Michael Mapison. What Gabe said,
incredible book.
Yeah, what Gabe said doesn't click with you, that's the seminal work on the topic.
I think it's been proven that expectations really drive returns, drive stock prices.
Most definitely.
Yeah. So, gross profit, gross margin, EBITDA, operating income. If you hit them, those are KPIs that are orders per customer could be one of them. What is social media? I think tracks ARPU. Annual revenue per user. That's kind of one of the big ones.
Average revenue or annual revenue per user.
Average revenue. Yeah, I think
that's correct. And DAOs and MAOs.
What's that one?
Daily active users, monthly active users.
Yeah.
Yeah, but those are less financial. So what I'm hearing you say is that that the top line business performance can be like, you can't get away from that being an incredibly crucial KPI. And then there's some that are going to be more specific depending on what industry, sector, type of company you're interested in.
And it's very simple. It's not very difficult, but I think if you are investing in stocks, you owe it to yourself to create some sort of tracker of KPIs so you know where the business is going.
Any favorite online tools for keeping track of that? Maybe future show sponsors. Wink, wink.
There was one, but it's for institutional use. This is something that you should be able to do. It takes 10 minutes per company, probably. It's not difficult.
How often should people be tracking KPI? So we know that earnings are printed quarterly. Is that a good timeline for this?
I think quarterly is enough.
If you go to expectations investing and what we talked about earlier with narrative, I think there's potential where someone could really get hurt by tracking some KPIs that they think are, capturing business performance in a good way, but the market is just like, the market narrative is really broken on a company. And when a market narrative is broken, the company's relationship with capital markets change, which is that negative feedback loop you just talked about, right? The company can't raise debt, can't raise equity to go get done when it needs to get done. There's companies who can kind of turtle down and weather the storm and, recover business performance. But that's the art and the challenge of all this. That's why it's not straightforward to make huge returns every year, right? And why investing is so idiosyncratic and so specific to each individual investor.
Yeah, the market makes up, a group of people who have different points of view.